Hi everybody, Thomas here at Rebel Income. For most of the last 5 decades, the financial markets have conditioned investors like you and me of the dangers of ignoring the Federal Reserve's moves around monetary policy. Whether rates are increasing or decreasing, we've learned to take our primary cues from the central bank because the markets have proven they will rise and fall depending on the attitude of the Fed and its governors about the state of the economy. Since 2022, we've been dealing with the specter of higher interest rates as the Fed has worked to slow the pace of economic activity in the U.S. Since the beginning of 2024, the market has started to price in the expectation that the Fed will finally begin lowering rates at some point this year. Last month, even Fed Chair Jay Powell stated the central bank's expectation for as many as 3 interest rate cuts this year, even as he declined to specify when they might happen. That's increased the expectation that the Fed will indeed manage to pull off the so-called soft landing they've been talking about for most of the last 2 years. It was even enough to give the markets room to rally to fresh, new, all-time highs last month following his statement. Now, economic soft landing sounds good because it means the Fed will manage the precarious balancing act of curbing the worst effects of inflation without propelling the economy into outright recession. I call that precarious because timing is everything. And frankly, history isn't really on the Fed's side. In fact, the longer this speculation continues, the more I begin to see parallels between current conditions and one of the worst economic periods in the last several decades of American history. We're going to talk about that time in this video and discuss some of the things we can do as investors to protect ourselves. Before we dive in, I want to invite you to check out my Rebel Income Patreon page. I publish daily exclusive access content on this page, from stock reports detailing my analysis in search of the trades I publish for my trade alerts to lists of underpriced dividend-paying stocks. You can also sign up for exclusive access to my weekly live webinar, where I discuss current market conditions while the market is open in a dynamic group learning environment. You'll find the link to my Patreon page in the description area of this video. Take a look, sign up for a free 7-day trial of any of my Patreon levels. I know you'll find something that you'll be able to use in your own trades. The mistake the Fed is really at risk of repeating is far enough back that a lot of investors are now too young to remember it. But it's real enough with ramifications that can't be ignored. Now, this chart shows the pace of inflation on a yearly basis, which is the orange line, with its growth rates on the right side of the chart. The blue line, on the other hand, displays changes in the Fed funds rate, which is the rate that the Fed charges to banks across the United States. Its rates are shown on the left side of the chart. The Fed funds rate is the primary and most important tool the Fed has to encourage or restrict economic growth. Now, this chart covers a roughly 20-year period from 1961 to 1982. By the end of the 1960s, we can see inflation, the orange line, had increased steadily from a little below 2% to about 6% by the end of 1970. The Fed raised the Fed funds rate as well during this time until 1969, when it believed the effect of steady rate increases had done its work, and they began cutting interest rates. After a brief decline from 1970 to 1972, inflation bottomed at a still high level of 5% and started going up again to a peak above 10.5% in 1974. Again, the Fed raised rates to about 10% by 1973. After another temporary contraction of both inflation and interest rates, inflation accelerated to peak at 14% in 1979. The accelerated pace of this increase forced the Fed to raise rates to just a little below an incredible 20% by 1980 before inflation finally began to fade on a sustained basis. The mistake the Fed made during these years, on 2 different occasions, was to declare victory and start lowering interest rates while inflation was still high. Shouldn't be a surprise that those reductions spurred a new increase in economic activity, but since inflation was still high, the result was to accelerate inflation beyond a sustainable pace. Persistent high unemployment and elevated prices created one of the longest recessionary periods since the Great Depression and that lasted until about 1983. I was an adolescent back then, but I was still old enough to have the image burned into my mind of cars lined up for blocks in front of us all the way to the gas station, while my dad and I waited for our turn to put a few dollars worth of gas in our family car. It's a lasting memory of a difficult period for most of the families living in the neighborhood where I grew up, and that I now believe didn't have to happen if the Fed had shown the determination to do their job correctly in the years prior. To give you a visual idea of what the inflation and interest rate picture looks like today, I've plotted the same data over the last 14 years. We can see that from 2022 to 2023, inflation dropped on an average annualized basis from 8% to 4.1%. That decline has set a lot of experts to declare that it's time for the Fed to start lowering the Fed funds rate from its current level above 5%. A lot of those same experts would like to see those rate cuts begin happening now as opposed to later, which the Fed is currently planning. The risk that I see is that while inflation has come down, I believe it's still too early to actually start decreasing rates. Don't forget, unemployment has dropped down to around its pre-pandemic record lows for the last few months. Jobs and wages have been two primary indicators the Fed has used for the last 4 or 5 years as barometers for monetary policy changes, and a healthy job market hardly screams the need for more accommodation through rate cuts. Historically, the Fed has targeted a 2% annual rate of inflation as its benchmark for a healthy economy. With inflation at 4% at the end of 2023 and more recent numbers a little bit above 3%, there's still room to go with margin for error built in that even Fed Chair Jay Powell acknowledged last week could see inflation start to pick up again if the Fed starts cutting rates too early, as they did in the 1970s. The market will certainly be paying a lot of attention to a new slew of reports this week, including the Consumer Price Index report that's used to track the ebb and flow of prices paid by consumers. The only real argument for rate cuts that can be made in that case is if the CPI numbers come in weaker than expected. If the report is stronger than predicted, or even in line with expectations, I think the case for keeping rates where they are and continuing to delay any cuts is the wiser course. There's a lot of different schools of thought about what you can do to protect your money and your purchasing power if the Fed cuts rates prematurely. One simple step you can take is to begin increasing the amount of cash in your account. Now, I'm not calling for a bear market, nor am I suggesting that it's time to liquidate your positions and put all of your money on the sidelines. I am saying that if you have profitable positions that you've been holding, it's probably a good time to think about booking some of those profits so you can increase the amount of cash in your account. If inflation spikes again, the markets can be expected to turn bearish pretty quickly. And that means that a lot of stocks will begin selling off. Having more cash in your account means you'll likely avoid the worst of those declines. You'll also be in good position to take advantage when those stocks reach compelling bargain levels. Another step that is very much worth considering to keep your cash drawing useful interest right now is to take some of that increase in cash and think about buying bonds. Interest rates are inverted right now, which means there are higher rates available for shorter term notes than for long-term bonds. That's an exception to the rule, and it means that you can buy high-quality Treasury notes with durations of 1 year or less and earn between 5.05% and 5.3% interest right now. By comparison, a 5-year bond pays only about 4.4%, and a 30-year bond pays just 4.54% on an annualized basis. So you can get higher yields with quicker access to your capital by buying bonds with durations of a year or less. That keeps your cash drawing useful interest above and beyond what you'll see from most current bank savings rates. My final suggestion is to be conservative and very selective about the opportunities you choose to take under current market conditions. It's tempting to gravitate to the stocks everybody's talking about that are trading at or near all-time highs, but those are the stocks that I believe represent the greatest degree of risk right now. I'm a dyed-in-the-wool bargain hunter by nature, because even when the rest of the market is trading at or near all-time highs, and the risk of a new bear market and recession is increasing, there are always good, underappreciated companies to be found at or near historical lows. If you find a good company that also pays an attractive dividend, you have a passive income source that may be competitive with available bond yields, with significantly less risk of the major downside stocks at all-time highs are seeing. Do you remember the 1970s and early 1980s like me, and all of the economic difficulties of those years? What was it like in your corner of the world? What did you and your family do to get through it? How did that experience impact the decisions you make today? I watched my parents pinch pennies till they screamed. My mother was a champion coupon clipper and shopper because she had 6 kids to feed. Our parents' frugal habits taught my wife and I to do the same while raising our own family years later, and those habits got us through some difficult times. Leave a comment below about your experience, and let's have some fun comparing notes. If the idea of finding useful stocks trading at reasonable valuations under any market condition with useful passive income built in is attractive to you, I'd like to invite you to become one of my Patreon members. You can sign up for a free 7-day trial for any of my patron levels by clicking the link in the description area of this video. If you like my content, go ahead and give me a like on this video and subscribe to my channel. Your engagement will help my channel grow so I can keep giving you terrific new content here. Thanks for your time. I'm Thomas, happy investing.